What's up, guys? Mike Sharp here again. This is Sharp Investing, and I'm going to talk about QFIN. It's been almost 2 years since I did a video on QFIN, and I got a question from a viewer asking what I was doing at these prices after this nice crash that we've had to like 22 bucks all the way from over 40. Now, I originally did a video in almost 2 years ago when it was in the $14, $15 range. It's subsequently tripled, and then now it's down over 50% again. So we're going to dig into why it's crashed. But first, I'm going to talk about some of the great things about this business. Like if you are a quant brain value investor, this thing screens extremely well and probably better than anything else that I know of. But there are some concerns, and I think it's worth talking about those. But we'll do the quant stuff first. And actually, first I'll do a company overview. So the company is a high interest consumer lender. They have a few different types of revenue streams. They loan off the balance sheet to people that to borrowers that they generate through their app. They also refer those borrowers to financial institutions for a fee. So that would be the asset light model. And then they've got other fees that they can charge financial institutions for, for scoring and managing borrower behavior. They're a bit like a credit card. Credit cards didn't really take off they're not as huge in China as they are in North America. So think of this as a consumer purchase loan where you buy something and then you're expected to pay the balance off within a year. The average payback tenure is about 10 months, and the average size of the drawdown on these line of credits are about 9,000 RMB, or it's about 1,200 bucks. So that's sort of how to think about them. They're very heavily scrutinized by regulatory bodies, so there's a lot of rules for them, and there's a lot of rule changes that we have to keep an eye on. I've been in this space for a while. I owned a company called QFIN that was terrible. And QFIN gave me an idea of what to look for in a blow up scenario. They were doing fine and then they blew themselves up. So I will share that info with you this video. They're also expanding to the UK, which is a bit weird to me. That seems like not a natural progression, but let's leave that one for now. Okay, why does this thing look great on a screen? Now, any number you look at looks good here, right? The EPS is trending over, $7 for the year. With the thing trading at 22 bucks, it's right around 3 times earnings for 2025, which is crazy. So you've got a 33% earnings yield, and you've got a ROE that's over 31%. You have equity. They have a price to book less than 1. And most of that could be converted to cash. Like if they just shut down the business, it's mostly just cash and receivables on their balance sheet. And if they collected the normal amount of receivables, then they would be able to liquidate the company for more than $22 a share right now. So any kind of metric you look at, price to free cash flow is like under 2, I think. But maybe we don't want to talk about that one because it's not as good a metric with a lender. So if we use earnings, totally fine. Now, there are some concerns with this stuff, but I will talk about those in a bit. Normally with companies that are trading so cheap, you think, well, why are they trading so cheap? There's got to be some hair on it. There's got to be a problem. And sometimes that problem is that they're a value trap. They're making a lot of money, but not much money is being returned to shareholders. Not the case with QFIN. They have returned 777 million in buybacks over the last 2.5 years, which is 23% of the float. So they bought back 23%. A lot of that was at high prices too. So if they went forward and did that again, they would buy back more of the float because it was running over 30 bucks for one of those years. Now going forward, they have another 170 million authorized. Plus they have a convertible note for 450 that would also reduce the share count pretty significantly. And both of those together would be another 15% of the float reduced over the next 12 months. And I think that they can do it. They have the cash balance, they have the cash flow, and they're pretty committed to this stuff. So upside there is another 15% return. I do expect them to keep doing buybacks over time. Dividend on top of that, so you get more capital returns. Like this is it's running at $1.52 per year right now. They pay it semi-annually, and they increase it all the time. Right now, that rate is at 6.5% as of today, November 5th, but it does fluctuate. So again, everything's looking good from a numeric standpoint. Why wouldn't you want to buy this, right? If you're just looking at the numbers. 3 times earnings, huge buybacks, good dividend. Even delinquencies look decent, right? We went through a period where delinquencies started to creep up, and that was during it's not really a recession because the economy was still growing pretty significantly, but they had a real estate contraction in China that hurt a lot of the consumer spending, and that peaked 2021, 2023, and delinquency rates are right back down. So the idea is that they have gone through a recessionary period already. The earnings did contract. They contracted to about 600 million at the bottom, which is still it's still what, 5 times the market cap right now at 3 billion. So we're trading at 5 times trough earnings as well, and they've shown that they can survive these negative shocks to the economy. All right, so the concern side, there are some pretty real concerns here, and I'll go through them a little bit. But if you haven't read the Grizzly short report, I would download it, or at least put it in AI and get the gist of it. But I'll go through a few of the things here, which we can dig into. Some of the obvious ones here are the guidance for Q3 was pretty weak. They expected a contraction of 2 to 13% in EPS. So we're going from a growth situation. I should mention that they're actually still growing the donor base as well. That's another one of the numbers that looks really good. I think they're up to 60 million approved accounts, and then borrowers with an active loan balance is up 15% to 37 million. So they're still doing well and growing their donor base and activating them. So back to the EPS contraction, that's obviously going to be a concern for the market. And one of the things you'll see is that the Q2 report came out, but the stock had already fallen 25% before then. So I do, my antenna is up. I think that looks a little bit like insider trading. And we'll get into more of the insider sells afterwards, but it looks like there was selling prior to this release, and then maybe something's happening right now in the same way that caused that 20% one-day drop. So front running is an issue. You could turn it to your advantage if you start seeing insider selling. So just something to think about. I have not seen insider selling recently, though, to a large degree. So that might mean that we're closer to the bottom. So one of the things was EPS guidance was lower for Q3. They also have a lower proportion of the capital light lending on the last report, and which means that the capital heavy stuff is on balance sheet, so it's more risky to them. So the investors were liking that they were moving more towards this capital light model over the last few years, and now it looks like it's kind of moving back a bit. We don't know. Maybe the lenders, the financial institutions that were buying those loans, are finding they're not working out that well, so they're taking on fewer of them. We don't actually know that. They didn't give us the information on this last report. So that's some of the reasons this could be down. And then the big one would be there's a fear over the rate caps, right? Because like I said, this is highly regulated, and over the time I've watched this space, it's gone from quite high, I don't remember what it was, and then they capped it at 36% maximum annualized rate, and then they cut it to 24%, and now I think it's actually going lower. Now, if we dig into the Grizzly report a little bit, they think the actual annual rate is 12%, and that QFIN is overcharging and just flaunting the rules, basically. I don't know if that's actually true, because I think that if we just think about this logically, I should say there is a rule there. Lenders are capped at 3 times the loan prime rate, but I'm not sure that actually applies to QFIN and their space. It doesn't apply to credit card lenders, so I think QFIN is more in that camp. But I think if we think about this logically, like it's very highly regulated. I'm just a guy sitting, across the ocean, and I'm able to find out that they're charging 23.4% annualized rates on their loans. They make it pretty clear and pretty easy to find that out. And I find it really hard to believe that this highly regulated business, the regulators don't know that that's happening. I think that doesn't make a lot of sense to me. You could find it out in 5 minutes if you tried. So I think they are within the legal boundaries here, probably. But I've also seen another report that they're going to cut that rate I was talking about at 24 down to 20%. So I think that might be the more legitimate risk, that's coming down the pipeline. And I wonder if that is also front-running people selling that news before the fact on that 20% drop day in October. Not sure, just a guess. But I'll go through an example. Actually, let's do it now. So here's an example of what it would look like if they actually cut to a 20% cap, right? So last 12 months revenue, 2.6 billion, and the net on that's just over $1 billion, right? And if they cut the cap on the lending rate, let's just say that applied to all the loans equally. It won't, because there's those fees. We don't really know what's going to happen on the capital light side. Like, those lenders would have to cut their rates on their side, so they'd probably end up having to cut the fees to QFIN to maintain their risk reward balance. I don't know. So what I'm going to do is I'm going to say the cost is going to stay the same, but the revenue is just going to come down by 1/6, which is 4% of 24, right? So in that scenario, very simplistic. I mean, you could do a more complicated model, but I think this is a safe, simple way of doing it. Revenue would come down to just below 2.2 billion. And on the same costs, the net income would go to 570 million, which is a 44% drop from where we are. So if that were true, then we're looking at an instant change from a PE of 3 to a PE of 5.3. Plus, you have the impact on the potential buybacks and the dividend, right? Those might get cut proportionally too. Instead of getting your 15 plus 7 or 14 plus 7, 21% capital return from buybacks and dividends, you might get 12 or 13%, right? So that could have a massive impact. It won't kill the business, but it's possible it will impact the valuation and the capital returns and stuff like that. And it's possible that that's priced in already. I mean, this thing was already over $40. And like I said, it's come down more than 50% already. And I think that earnings could drop 44%. So maybe this is priced in. Possible. More concerns, let's talk about Grizzly stuff. They were saying, one of the things they were looking at was that there might be accounting shenanigans. They're saying they're seeing differences in the SEC versus the reported numbers. I'm not 100% sure about that. I haven't gone in depth on that stuff yet, but something to look into. And they're also saying that it's possible that QFIN is actually required to guarantee the off-balance sheet loans. That might be the bigger one. So if they're actually, they accuse them of saying, of underreporting their exposure on this stuff. So if we look at, so right now, well, this is the 2023 numbers because they did the report in 2024, but the off-balance sheet loans were 1.3 to 1 to equity, but they're saying if they included all these off-balance sheet ones, it would go to 8.5 to 1. Now that's a pretty big jump, and that's sort of in the range of what banks actually run at. But banks have more secure loans. They have real estate and other assets backing a lot of those loans, whereas these are just unsecured consumer loans. So it's quite a different scenario. But I think the counterpoint to that one is that if they are required to guarantee the loans off balance sheet, well, they're already doing that. That's already priced into the income statement, right? It's not like we're not waiting for a blow up. They still have delinquency rates, so those should be included already. Now, if the delinquency rates spiked, then there would obviously be a huge problem if this were true. But I don't know. You need to do your own research there. Now, I should talk a little bit about delinquency rates. That's the key number here. That's the only one to me that is super important. We have to keep an eye on those. Like I said, I invested in QFIN, and their delinquency rates started going up because they started getting sloppy or more liberal with their loans and selecting borrowers that were less creditworthy. Delinquency rates went up, and what happens as a result of that is your delinquencies on your on-balance sheet stuff goes up. You know, obviously you're gonna have to write a lot more of those loans off, but then also you lose your capital light customers too, because they don't want the garbage that you're giving them, right? So it can really sink the business if the delinquency rates go wrong. It can go bad in a hurry. So it's just important to understand that this whole business is built on being able to assess creditworthiness and not have these spiking delinquency rates. History looks good for them. They haven't had real problems with this. It looks like their AI models are quite good at selecting borrowers. And as we know with AI and more data, it usually gets better over time, right? So they might actually be better than they were, say, 2 or 3 years ago when the delinquency rates started going up. The last thing that Grizzly brings up is these insider trades. So there's a high level of insider trades, insider sales specifically, not buys. So if we look here, we can see that Yang Zheng, this is a red flag for me. The chief risk officer has done a few large sales over the last year. He sold 37 million worth of shares in December 2024, and then he sold another 4 million in late June 2025. So this is the chief risk officer. This is the guy who knows the guts of the business. And, you know, that's a little bit concerning to me. I also wonder if this buyback is meant to give exit liquidity to the insiders, right? So they don't want to tank the stock any more than it's already down. So they need some liquidity. You know, you can see there's quite a lot of sales over the last 12 months, over the last year and a half. I would say, what's that? Just eyeballing it, it's probably close to 80 million in insider sales. You know, vice president, directors, all this kind of stuff. Now, we know that sales are not a very good indicator as to what's going on in the business, but I think for me, these large sales by the chief risk officer are pretty concerning. Now, like I said, we haven't seen that many since recently, which is maybe a positive sign, or maybe they were just taking advantage of the higher prices then. I don't know, something to keep in mind. Okay, so then for all these concerns, the counterpoint to all of them is that this company has gone through, not all of them, but some of them, is that this space has gone through a lot over the last 10 years. I've been watching it since, I don't know, 2017 or something. And the government's all over this. And a lot of the players in this space have blown themselves up, right? They had this big peer-to-peer lending mess. And then all these people were like, you know, all these companies were doing fraudulent loans and screwing people over. And QFIN has just survived the whole thing and continued to just print cash through it with all the regulatory changes, right? So they are a survivor. They know how to make money, assuming the books are not cooked and the numbers are as they say. But like I said, trough earnings, they went through the economic contraction in 2022, 23. They're just trading at 5 times that. Now, if you had that plus the interest rate cap coming down, it could go lower. But on the other side of it, they're still growing. They're still attracting new borrowers and improving their AI models and their scoring and stuff like that. So, you know, I think that having survived this long shows that they're not at a huge risk of blowing up right now, especially with the economy doing well. Now, the question at the beginning was, what am I doing? Maybe you don't care. I care. So my belief on stocks is that the trend is, you know, it's cliche, but the trend is your friend. I think that an object in motion tends to stay in motion. And right now, the trend is down, right? This is the proverbial falling knife. We don't know where the bottom is. Maybe it'll just V bottom straight back up. But I think with these concerns in place, it's likely not going to. More likely what will happen is it will find a bottom and it'll hang around there for a while before it's able to turn up, before they adjust to this new earnings environment and then start gaining momentum again. And then you have if all your numbers start coming down for a while, you have to wait a year until the comps start looking good, right? You get the new base and then you get one more year. So I think I'm going to keep watching this for margin of safety purposes. I'd like it, closer to $12, $13 to protect against that interest cap risk. If it fell down that low, I might take a position in it, even if the trend was still down. But right now, it's probably, even though it's super cheap, it's not cheap enough for me to jump in, because I don't want to be sitting on this for 2 years while it finds a base and makes a base and then turns up, right? I'm going to keep an eye on it and just take a look at the next two earnings and see what happens. So no, I'm not buying it. I should mention I did sell it pretty soon after I bought it last time because I had actually better place to put the money. I ended up buying Nubank and AppLovin. Now I think QFIN did better than Nubank, but AppLovin did better than anything I've ever owned. So that ended up being a good trade, even though QFIN did quite well. So what's the bottom line to this from a business perspective? So if the short report is true, or if it's not true, and the company just keeps doing business as usual, reporting earnings, returning lots of cash to shareholders, this could be a pretty good winner whenever the situation is correct and all this sort of bad news is digested and through the system, right? If they're buying back 15% of shares a year, let's say they can keep doing that. Probably not if the rate cap comes down, but if they did, then you basically get a double in your EPS just from buybacks in 3 years, right? So you could see a double in 3 years. Now, if the short report is true and cracks start appearing, there is the potential for a zero, right? I'm saying, yeah, they do have this equity margin of safety. They have more cash, ultimately liquidation cash, than the market cap. So that should be a margin of safety. But if the books are cooked, that doesn't protect you if there's not actually any cash there to do that. Maybe there is cash, but it's less. I don't know. I'm not a forensic accountant and I don't intend to be with this business either, right? So, there is downside risk. And for me, if I'm buying this eventually, if I get the pitch that I want, I'll probably size it with the downside potential at zero. I have to size it properly. So bottom line is I'm not doing anything right now. It's an interesting business. I always keep an eye on it, but it's not quite the pitch that I want just yet, although it does look quite good on a number of fronts. Anyway, I'm sure we'll get some more information here on the next earnings report they release. It shouldn't be that long now, maybe give it a week or two, and then maybe what I've said is irrelevant. Maybe I'll do another video, maybe I won't. Anyway, if you got this far, thanks so much for watching. Catch you later.